The total value of stocks traded on the New York Stock Exchange increased from $27 billion in 1925 to over $87 billion in 1929. In today's episode, we continue our journey into the Wall Street crash of 1929. Causes of the speculative bubble. The speculative bubble that fueled the stock market's rise in the 1920s had several underlying causes. Let's delve into the factors that contributed to the excessive optimism and risky behavior of investors. Easy credit and loose monetary policies during the 1920s allowed investors to borrow heavily to invest in stocks, leading to an unsustainable bubble. The expansion of installment buying and the proliferation of investment trusts further fueled the speculative frenzy. Income inequality was on the rise, with the wealthiest individuals accumulating significant wealth and investing heavily in the stock market. The role of margin trading and speculation. Margin trading played a significant role in amplifying both the gains and losses during the market boom. Let's explore how margin trading and excessive speculation contributed to the eventual crash. Margin loans reached unprecedented levels, with investors borrowing substantial amounts of money to invest in stocks, often leveraging their investments up to 90%. Speculative practices, such as buying on margin and pump and dump schemes, were widespread, driving stock prices to artificially inflated levels. The total value of stocks traded on the New York Stock Exchange increased from $27 billion in 1925 to over $87 billion in 1929, reflecting the speculative fever that gripped the market. The domino effect, Black Thursday and Black Tuesday. The crash was not a sudden event but rather a culmination of a series of significant market declines. Let's examine the key days that marked the beginning of the end for the roaring stock market. On Black Thursday, October 24, 1929, panic selling gripped the market, leading to a significant decline in stock prices. The Dow Jones Industrial Average fell by 11% that day. The panic intensified on Black Tuesday, October 29, 1929. When the market experienced its most dramatic crash, erasing billions of dollars in market value. The Dow Jones Industrial Average plummeted by 12% that day. By the end of November 1929, stock prices had declined by nearly 50%, wiping out billions of dollars in wealth. The widespread economic fallout. The crash had far-reaching consequences beyond Wall Street, as it reverberated throughout the entire economy. Let's explore the broader impact on businesses, banks, and individuals. Businesses faced widespread bankruptcies and closures, leading to a sharp increase in unemployment rates. By 1933, the unemployment rate in the United States reached 25%. The crash triggered a wave of bank failures, as depositors rushed to withdraw their funds, causing a severe strain on the banking system. Over 9,000 banks closed their doors during the Great Depression. Gross domestic product, GDP, declined by 30% between 1929 and 1933, reflecting the depth of the economic contraction. The Great Depression, and lasting effects. The Wall Street crash of 1929 marked the beginning of the Great Depression, an era of economic hardship that had a profound impact on the lives of millions. Let's delve into the lasting effects of this economic crisis. Stock market values did not recover to pre-crash levels until 1954, more than 2 decades later. The crash led to significant regulatory reforms, including the establishment of the Securities and Exchange Commission, SEC, in 1934 to oversee and regulate the securities industry. The crash highlighted the importance of government intervention in stabilizing the economy. It paved the way for President Franklin D. Roosevelt's New Deal programs, aimed at revitalizing the economy and providing relief to the American people. Lessons learned and the modern financial system. Host, the Wall Street crash of 1929 continues to serve as a reminder of the risks inherent in speculative markets. Let's reflect on the lessons learned and their impact on the modern financial system. The crash highlighted the need for effective market regulation, risk management, and investor protection, shaping the development of financial regulations and practices. The crash contributed to a shift in public sentiment towards a more cautious approach to investing, and a recognition of the importance of diversification and long-term investing strategies. The crash remains a significant event in financial history, and has influenced subsequent market crises, shaping the understanding of market dynamics, and the importance of systemic risk management. The Wall Street crash of 1929 serves as a powerful reminder of the consequences of speculative excesses, and the interconnectedness of financial markets. It continues to inform our understanding of market dynamics and the importance of responsible investing. Thank you for joining us on this captivating journey into the history of the Wall Street crash. If you enjoyed this video, don't forget to like and subscribe to our channel.